All right, as we have been reporting, U.S. weekly jobless claims hit their lowest number since July of 2008. And while stocks rallied on that news, we also learned that sales of new homes dropped in October more than 8%. Joining us now to sort out today's economic news, Ethan Harris of Bank of America Merrill Lynch. He heads the Developed Markets Division for Global Research. He's one of the most accurate forecasters of the U.S. economy, according to Bloomberg data, and that's why we call him a Bloomberg Best. Also joining me here in the studio is Joe Brusuelas, a Bloomberg economist, a friend and colleague for many years, and I was just telling Ethan that I love to read your research every morning. You send me little blips, little bite-sized pieces that I can maybe deal with a little bit better than the big, long notes. This morning I saw a flood of positive notes from economists, even from some of the most bearish guys out there. Peter Bookvar over at Miller Tabak usually seems to try and find the dark side of every piece of news. And this morning he said, okay, the jobless picture looks good. Ethan, are you as impressed with the jobless numbers as it seems most economists were this morning?
Yeah, I mean, this is the key indicator, the job market. I mean, right now we're more than a year and a half into recovery. Normally you'd be looking at massive job gains, something in the 300,000 range, and yet we've been kind of stuck in the mud with these very weak numbers. The good news is that in the last couple months we're now starting to see a drop in claims, and that's an indication that maybe the job market is picking up. So I do think of all the data we got this morning, that was certainly one of the more positive numbers.
And we were just talking about one of the economists that works with Ian, Michelle Meyer. She has been focusing on housing. Normally it's housing, right, Joe, that pulls us out. Normally it's housing that adds those 300,000 jobs that we would expect after a recession, and it hasn't happened. And today's housing numbers were dismal.
That's right. Normally you see interest rate sensitive industries such as housing and autos, pull the economy out of recession, and we're not seeing that this time. This time it's actually manufacturing, and we hope we're starting to see signs of life in the service sector, which will, create jobs. Ethan's right. That jobless claims number was the big number today. The 4-week moving average has dropped to 436,000. I think we're now at a pace to add jobs roughly near 150,000 per month, and that's exactly what we need to see to stabilize the labor force and the unemployment rate right near 10%. Also, that personal income and spending numbers, the income and the spending especially numbers were quite good today. I saw something there really to get positive about, which is consumers are actually increasing their savings while they're increasing spending, and income's actually rising. Income outpaced spending this month for the first time in a couple months, and that was good. We need to see those sort of data persist and be sustained for us to really begin to gain some traction and momentum so we can get out of the ditch.
But how key are the housing numbers? I mean, Ethan, if we continue to see bad housing data, if we continue or maybe even see another drop in home prices and home sales, can we expect jobs to pick up? Aren't the two so closely interlinked that housing has to do well for the labor picture to be better?
Well, I mean, housing is definitely a weight around the neck of the recovery and is likely to remain a weight around the neck for the next year or two, maybe even 3 years going forward. So it's going to make it very hard to get truly robust growth. It doesn't mean we can't get, okay job gains and get a little bit of improvement in the unemployment rate, but yeah, the housing picture is still quite grim, and I don't see an end of the tunnel in sight.
That's not happy news, right? If you don't see an end, and a lot of people, even the Fed, doesn't expect the unemployment picture to get much better. I was looking at your Facebook posting yesterday, and you had a chart showing that the Fed still expects us to see, what, 8% unemployment a couple years out?
8% unemployment through the end of 2012 and 7% unemployment through the end of 2013. That's correct. And we're going to have a problem with housing. I expect prices to dip another 5, maybe 7%. In November, the numbers are going to be ugly. The stoppage of foreclosures will slow down the healing process in the market. Distressed sales have captured roughly 34% of the share of existing home sales, and so what I expect to see is the share of sales actually fall further. So we're going to get another couple months of this before they even get better, and we're just going to be bouncing along the bottom of the homes market for some time. I think what we need to do is focus on what's good here. Trade's good. We're building, investment, and hopefully we can gain some traction in the employment market.
Was QE2 even necessary for this, Ethan? I mean, what's your take on that? It looks like things were getting better. It looked like things were getting better before we got the QE2 announcement, and the numbers continue to get better. Is it necessary? Do we even see the Fed complete those purchases?
I think the Fed's very likely to complete their purchases. We need to remember that the Fed did QE2, even though they're expecting growth of between 3 and 3.5% next year. That's what they told us in their minutes. So they're expecting pretty good growth in the year ahead. They're not going to stop if all they do is get what they're forecasting. So I think a lot of the talk about the Fed, kind of tugging that boat back to the dock is very premature. We need to see really solid growth, signs of a drop in the unemployment rate. Otherwise, the Fed continues to buy.
Now, a lot of our viewers may not know that Ethan spent some time working at the Fed, actually a good amount of time. And a lot of our viewers hear this term monetary transmission mechanism thrown around. Can you explain that for the viewers and explain why that's so important and what the Fed's trying to do there to actually increase the allocation of credit in the economy?
Well, the Fed, I think, understands that the monetary transmission mechanism isn't working normally. In other words, the Fed adds reserves to the banking system, and normally banks would go out and lend very aggressively. In this environment where banks are repairing their balance sheets and where customers have very low confidence in the recovery, there's very little that those reserves actually turning into loans. So in effect, the bank lending channel isn't working. What that means is the Fed has to try even harder to get growth going. So rather than rely on a big bank lending boom, they're trying to get a rally in the stock market and bond market to stimulate growth. And that's a lot harder channel to use to stimulate growth. So the lack of traction in the bank lending channel is really the main reason why we're in this extraordinary monetary policy from the Fed.
Are there risks? I mean, are you concerned, Ethan, about risks to that strategy? Unintended consequences, so to speak?
Yeah, I mean, in a normal environment where the Fed was just cutting interest rates, I think it would be a no-brainer. The Fed, given the high unemployment rate, should be cutting rates and stimulating the economy. The problem with QE2, with this quantitative easing policy, is it can do things like stoke bubbles in commodity markets or in emerging markets. The last thing the Fed wants to see is a big boom in oil prices. That would be bad for the economy. So clearly there are some negative side effects here, and that's why the Fed did kind of a cost-benefit analysis before they started this program. I still think on net it's probably the right thing to do, but I'm sympathetic to people who argue that, the costs exceed the benefits.
All right, Ethan, thanks for joining us. Ethan Harris there from Bank of America Merrill Lynch. Joe Brusuelas on set with us. Thanks so much. Good to have a roundtable on that, and obviously it's something that we're going to continue to follow very closely.